Hello and welcome to the latest episode of On the Money, a weekly look how to make the most out of your savings and investments. In this episode, we're going to delve into the biggest stock market theme over the past 2 years, which is artificial intelligence, AI. Joining me to talk all things AI is Chris Ford, Fund Manager of the Sanlam Global Artificial Intelligence Fund. So Chris, to kick off, could you explain what the investment criteria is for a company to potentially win its place in the portfolio? Does a company need to have a certain percentage in terms of revenue from activities involved with artificial intelligence?
It's interesting the way you introduced me because for us, of course, AI isn't about just the last 2 years. It's about the last 8 years. And we've been running our strategy for 8 years now. So for us, engaging with AI in a fulsome way wasn't something that came to us as a function of the availability of ChatGPT. It's something which predates that very significantly. And I think that's very important because for us, AI has not merely been the most important theme in the market for the last couple of years. It's been the single most important thing for the duration of the life of our product. And we have, I think, a perhaps different apprehension and perspective of what the theme is as a function of that longevity of engagement with the theme. So for us, we want to invest in companies whose economic future is entirely dependent upon the artificially intelligent systems upon which those business models are founded. In many cases, that will be about weight of revenue. What proportion of that economic activity is actually sitting on top of those platforms at the moment. But in other cases, it'll be a little bit different. There are many and increasing numbers of companies that have been around for potentially decades in some cases that are now beginning to engage in a really meaningful way with the artificially intelligent world. Our contention, of course, is that all companies at one point or another over the course of the coming decades will have to be fully engaged with the artificially intelligent world. If they're not, they will cease to find a role for their business. So for us, yes, of course, weight of revenue is important, but it's also about change. And so for us, if we can find companies who are reinventing themselves through the application of artificial intelligence systems to change the way in which they do business, to revolutionize their business processes within those organizations, then those are absolutely the kind of opportunities that we think we should be taking to our fund holders. And so when we're looking for those companies, we're looking for a correlated change inside those businesses. That might be a change in the revenue growth rate at the top line, or candidly, it might be a change in the business model. So it might be an inflection, a meaningful correlated inflection in the middle of the profit and loss statement, for example. So we're finding companies in some parts of the economy that are able to significantly enhance their operating margins, for example, as a result of using artificial intelligence systems to transform the way in which they operate inside themselves. That might not necessarily result in a significant inflection in the revenue growth, but it will significantly change the shape of the overall business model and the earnings generative capacity of those business models. So for us, yes, it's about weight of revenues, but it's also about change and the ability to invest in companies where the overall economic outcome is fully dependent on those artificially intelligent systems.
And how broad is the theme at the moment? Do you have a universe of companies that you're looking at, and how big is that universe?
Yep. So we have a universe of companies that we define. We use an artificial intelligence system to help us to define those companies. So we've been using the very technology that we're looking to invest in since we launched the fund. So again, for us, ChatGPT wasn't the first encounter with natural language generation, natural language processing. For us, we've been using natural language processing in our investment process since 2016. So that's very important because it adds a degree of transparency and efficiency and consistency to our definition of our investment universe that maybe would be somewhat lacking if we were entirely reliant on the humans to do that. So our investment universe at the moment is about 1,000 companies globally. Now, there are about 20,000 companies globally that would be potentially able to be considered for inclusion in the fund on a liquidity adjusted basis. So they've got the kind of trading characteristics that would mean that we could safely invest in them on behalf of our clients. What we need to do is find which amongst those 10, 20, 25,000 equities have those artificially intelligent characteristics that we've already just touched on. And they number about 1,000 at the moment. So it's a long list, but we're removing about 95% of the liquidity adjusted investment universe. But that investment universe has grown over time. So when we launched our fund in 2016, the fund in 2017, we had an investment universe of about 250, 300 names. So we've seen a significant enhancement of the overall investment universe. And this is fantastic because, of course, what we've said consistently since we launched the fund was that we expected our investment universe to get bigger and broader and deeper and better over time. And what that, of course, does for me as the fund manager is it consistently raises the bar. for inclusion within the fund. So for those companies that are included in the portfolio at the moment, they need to continue to earn their position in the portfolio on an ongoing basis. And that incremental ongoing competition for capital just keeps all of us on our toes in respect to the management of this fund.
And in terms of the fund's top holdings, I've noticed that your top 4 holdings are 4 of the so-called Magnificent 7 stocks. So you've got Nvidia, Microsoft, Amazon, and Alphabet. Could you briefly talk us through each of those 4 stocks? And I'm assuming the remainder of the Magnificent 7 you don't own, as they're not in the top 10.
So we do own a position in Tesla, but we don't own it. We've never owned Apple. We've never owned Meta. I think, one of the features of the Magnificent 7 is that they've become magnificent because of their engagement with AI. So there was nobody referred to such a thing as the Magnificent 7 outside of the context of cinema reviews in 2017, 2018. We were talking about FANG stocks back then, you may remember. So the Magnificent 7 have been able to enjoy the extraordinary success that they have in no small part because of their engagement with the artificially intelligent world. So we make no apology for having them included in the fund, and towards the upper end. Nvidia particularly, I think, has caught many people by surprise. When we were talking about FANG stocks, the N in FANG didn't stand for Nvidia back at the time. So Nvidia, for many people, has come almost as though from nowhere alongside this extraordinary burgeoning in the artificially intelligent world. So these companies are companies that are largely entirely facilitated by their engagement with the artificially intelligent world. And specifically in the case of Nvidia, of course, has been very heavily engaged with the building of the infrastructure upon which the artificially intelligent world will be built. And that's really what we've been living through over the course of the last 18 months, 2 years or so, this building of the infrastructure. And we think of it almost in the same way as one might think about the railways in the early 19th century. The first thing you have to do before you start running trains is to lay the tracks. And without any tracks, there are no trains. So we've been laying the tracks for the artificially intelligent world over the course of the last couple of years, maybe a little bit longer than that. What we think we're now going to start seeing over the course of the coming few years is those trains are going to start running. And that's what's going to be really interesting over the course of the coming years. What do those trains look like? Where are they going? What are they carrying? And so for those large companies that you just mentioned, some of those are going to definitely participate in that occurrence. But what we're about to see, we think, is a significant broadening in the artificially intelligent participation rate, if you like, that we're going to start seeing those products and services layered in over the top of that infrastructure over the course of the coming years. And that will be a really transformative event for the economy.
And in respect to those 4 companies that your top 4 holdings, what's your view on their current valuations? Are they too rich? Are they sensible? What are your thoughts?
They're very different. I mean, I think one of the interesting things about this characteristic of the narrative around the large companies that are bunched together within the Magnificent 7 is the idea that they all look the same. They don't look the same. They're very different beasts. They just happen to be big. And we feel that the Magnificent 7 is a bit of a lazy kind of way about thinking about the market, to be honest. And so, yes, they all look very different in terms of what they actually do when you lift the hood and look underneath to see what the engine is. But they also look very different from a valuation perspective. It's difficult to argue that stocks, for example, like Alphabet, are necessarily expensive relative to their own history. On the other hand, some of the others are looking definitely more expensive relative to their own history. Nvidia actually looks somewhere in the middle. So, I think one has to take the time to look at what these companies are doing, take a view as to, the cash generative capacity of the business models, and then figure out what the appropriate valuation framework might be for looking at these companies. But they don't look the same. And so earlier in the year, Microsoft particularly looked very expensive. We were taking money off the table back at that point. Microsoft now sits on the kind of high 20s multiple, which relative to its history is not cheap. Neither is it egregiously expensive compared to where it's traded at points in the last few years. Alphabet trades in the high teens, 20 times earnings. Difficult to argue that that's expensive. It's a discount relative to the S&P, for example. So these companies are not the same, and that difference in the way in which they trade, the valuations that they trade at, obviously gives us as portfolio managers the opportunity to take a perhaps nuanced view.
Nvidia's the top holding. In the latest fact sheet I've seen, it accounted for 6.5% of the fund's assets. Have you been taking some profits in that stock? And do you look to limit exposure to a single stock? As I've seen some index funds and ETFs have a lot more than 6.5% in Nvidia, given how well it's performed since the start of 2023.
Yep. So we took a lot of money off the table in Nvidia earlier in the year, and then we went back into the stock in the middle of the year. We have a very particular framework for portfolio construction, which defines how we end up with the portfolio that we do. And what we look to do is we don't manage the fund against an index or a benchmark, because we don't think it's sensible to look at a largely irrelevant or non-comparable benchmarking index and use that as the means against which to construct the portfolios. Instead, we use the breadth and the importance of a company's engagement with the artificially intelligent world as a means by which we look to position size at a stock level, and from that we build up to the portfolio. And so for each company in the portfolio, we will define a maximal position size and we'll operate within that. And so for the more broadly exposed a company is to AI, the more purely exposed its economic future is to AI, and the more liquid the stock is, the larger the maximal position size we will hold within the portfolio. But keep in mind that we're a UCITS fund. So within the UCITS framework, we're limited to a 10% maximal position size at the security level. So we actually bring that down to 9% from a portfolio construction perspective to make sure that we've got a buffer of safety, to make sure that on our clients' behalf we're always safe within the regulation, and we'll construct within that. So our position in NVIDIA's got up to 8.5% of points. That would be pretty much as high as we would go in NVIDIA. We've been up there in stocks like Alphabet and other of the larger cap usual suspects over the AI space over the course of the last couple of years. We went into the most recent quarter with NVIDIA at about 7% and a bit, give or take, and that's where we sit at the moment. So yes, you're right to point out that other companies, other funds, other indices, other ETFs will have a potentially higher weight of exposure to NVIDIA, but we're not an NVIDIA fund. We're an AI fund. And if AI is going to demonstrate itself to be as robust and persistent and durable and important as we think it is, then over time, that is going to have to broaden out beyond NVIDIA. This is not to suggest that NVIDIA doesn't have its role to play. It absolutely does. We've run NVIDIA for many, many, many years. So it's been in the funds consistently since we launched in 2017, and we actually held it before that. We just need to reflect on and understand that it's not all about NVIDIA. There's a lot else to go for. And actually, when we look at the performance of the fund over the course of the last few years, NVIDIA has clearly had a huge part to play in that and contributed very helpfully. But we've had other stocks in each given year, which have actually, in many cases, done better.
So let's talk about the rest of the fund then. Could you talk us through how many holdings you have and what are the key sub-trends that you're playing within AI? And if you could give some stock examples, that'd be great to illustrate your process.
Yep. So the portfolio, when we think about what we're trying to deliver to our clients, we're trying to deliver a plain vanilla global equity fund. That is what this fund is. It's not a tech fund. Our average position in tech has been about 44-45% over the life of the fund. We're a bit more than that at the moment for some of the reasons, specific reasons that you've already alluded to. But for most of the life of the fund, the majority of the capital has been deployed from outside of the technology sector. We're not a North American equity fund. We have about 65% or so invested in North America. If we don't run the fund against a benchmark, but if you were to look at us against the MSCI World, for example, you'd see that we were actually kind of underweight North America relative to that particular index. So, we're trying to deliver a diversified global equity portfolio to our clients. And so, yes, whilst we find some really great examples of companies that we've invested in very successfully in the technology space, we've also found some great opportunities outside of the technology space as well. And we'll go right the way up and down the market cap spectrum. And our propensity is to hold stocks for a long time when we can find them. So about a third of the stocks that are held in the portfolio today are stocks that were in the portfolio in 2017 when we launched. We're very pleased about that. We like to be able to commit to business models and build partnerships with companies where we find the opportunity to do so. We found great opportunities in industrials, in consumer sectors, in communication services. We're actually got an Australian utility stock in the portfolio at the moment. So there are very few parts of the economy that are not or have not at one point or another been represented in the portfolio. And of course, that's very important because what we think we're able to do is to deliver a more robust, more resilient portfolio as a function of being able to be more diversified cross-sector, cross-region over time. So yes, of course, for the last few quarters, we all know that technology and North American stocks in particular have done extraordinarily well, but there will be periods when that's not necessarily the case. And I think we're able, with that more rich opportunity set than perhaps some other funds have, to be able to benefit from that. And that allows us some kind of incremental resilience that we can build into the portfolio construction. So to give you a couple of examples of stocks that perhaps make it into the portfolio where from a position that perhaps wouldn't necessarily immediately spring to mind, we have a position in an Australian utility company which had a management change at the back end of the last decade. This is a company called Origin. And the management team went in and realized that they didn't necessarily have any particular competitive advantages relative to their peers in the utility space in Australia. And what the new CEO did was to figure out that actually if he could do something differently with their data estate, then they were in a really interesting position to be able to operate their business in a superior level relative to his peers. And they went off and completely rebuilt and recurated the data estate upon which they stood. In so doing, I think they became AWS's largest client in Australia. And on the back of that, they've been able to build a number of really interesting solutions inflected with artificial technologies and now really dependent upon them, which allow them to go to market more efficiently, manage their consumer relationships more efficiently, manage the grid more efficiently, think differently about how they bring on and take off generation capacity according to demand. And also now in a world in which electric utilities are becoming a significantly important piece of the jigsaw in allowing customers to think differently about how they engage with their electricity provider. The requirement to deliver intelligence into that process is important. So perhaps before you just had a dumb pipe bringing electricity into your house. Now you might have solar panels, you might drive an electric car, you might have a wind turbine, you might be on a smart tariff, you might have a smart meter. There are lots of different ways in which your electricity usage is becoming more nuanced. And the ability to develop artificial intelligence solutions to manage that kind of flow of electrons in and out of property in the best interests of the consumer, but also of the supplier, is very apparent. And so Origin has an interesting position in Octopus Energy, which is one of the big UK as yet unlisted participants in this market. And we're watching very closely to see how that relationship evolves over time.
You've mentioned that you invest for long term, and around a third of the fund today was held when the fund launched around 8 years ago. How often are you reviewing the market and looking at the wider universe and introducing new names to the portfolio?
So we look at the market all the time. It's like sailing a ship. You've got to have your hand on the tiller and keep it pointing in the right direction. What you want to be doing is making small adjustments all the time rather than massive adjustments on a kind of, 6 monthly, 1 yearly basis. At least that's our experience as to how we managed to deliver decent experiences for our clients. So we are fully engaged all of the time. At the moment, in my experience, you take your eye off the ball. That's the point at which you start making bad decisions. So we're constantly reviewing the portfolio. We do that obviously on a day-to-day basis. We have a formal weekly meeting with our team where we have a huge amount of pretty rigorously and consistently prepared data that we have available to us that allows us to respond to it in a consistent manner. And what we try to do as well when we're thinking about stocks that we're looking to invest in is to build up that investment thesis really very, very comprehensively. And then we write it all down. And that discipline of recording what you do is so important. My colleague, Tim Day, who manages the fund with me, if he were here, he would talk about investment thesis creep. And he's let's call him experienced rather than old. He's been around for a very long time doing this job. And he would say that investment thesis creep is the single most invidious thing that can affect a fund's performance. The idea that you invest in a particular position for reason A, B, and C. And then all of a sudden you come in one day and reason A, B, and C have evaporated. The stock's fallen by 20%, but now it's cheap. And now you retain that investment purely and simply because of the cheapness. And that's almost always a bad thing to do. So what we look to do is to record all of the things that we have needed to believe in order to justify and support the investment that we're making. And then we look to distill those things down to the 3 through 6 things that we think absolutely must be true for an investment to continue to warrant its position within the portfolio. And we call those things our investment pillars. And if one of those investment pillars crumbles, then we will immediately look to reevaluate it. In all likelihood, we'll exit the position. And this is about trying to think ahead of time about how you might respond if things were to go badly. Because we will make mistakes. And we work in a world in which, not all investments work for you. But what we want to try to do is to understand how we might respond in the circumstance that an investment hasn't worked out in the way that we would expect, and to have gone some way towards understanding objectively how we ought to respond in that circumstance to take some of the heat and emotion out of the event on the day. But that requires that we are absolutely on top of the stocks inside the portfolio on a day-by-day, week-by-week basis, so that when those cracks begin to emerge in those investment pillars, we can respond and react quickly and accordingly.
And a key consideration for investors that are looking to participate in the future growth of artificial intelligence is whether to back an active fund manager like yourself. There are a few other options as well. Or they could simply back an index fund or an ETF that is playing the artificial intelligence theme. Or they could think, well, artificial intelligence, it's a growing area, so I'll just buy a global index fund or ETF as it'll have plenty of artificial intelligence related revenue and companies within that. So could you make the case for your fund? What would be your sales pitch?
Yeah, let me respond specifically to those two questions first, if I may. The majority of global equities don't have any meaningful engagement with AI at the moment. We are incredibly early in the adoption of these technologies. Most companies have barely begun, if indeed they've begun at all. There's lots of work from companies like Accenture, for example, looking to put some numbers around that. And I would suggest going and having a look at the Accenture website if you want to go and have a look at some of those white papers that they've written. So as I said, we remove 90% of the 90 to 95% of the liquidity adjusted universe as far as we're concerned, completely irrelevant for involvement with an AI fund. So, of course, if you go and buy a normal global equity fund, then you will have that opportunity perfectly reasonably available to those fund managers. And if they want to buy that, that's fine. That's what they do. It's not what we're going to do. And it shouldn't be, I don't think, what any global equity AI fund manager should be doing. Now, if you tell me that you think that all global equity funds will look like an AI fund at some point in 10, 20, 30, 40 years' time, then I would entirely agree with you. Because I don't believe that any company over that time frame will likely to be able to deliver the products and services that it does without having an artificially intelligent effort platform at the heart of what it does. But of course, if that's the outcome, then we've won. The whole point of this portfolio is effectively to be a global equity portfolio that is positioned where the puck is going, to use the ice hockey analogy, not where the puck sits at the moment. And of course, because that situation is evolving so rapidly, new companies are emerging that didn't exist before. New companies are going to increasingly, we think, over the course of the next 3 to 5 years, list in the public markets that aren't available to us at the moment. So lots of the companies that people may have come across, like OpenAI or Anthropic, these are not companies that you can invest in the public market at the moment because they're privately held. That will, I think, change over time. The pool of investments that will be available to us is going to change very significantly. And of course, as an active manager, I can take account of that on a minute-by-minute, day-by-day basis. So as soon as we see new opportunities coming into our universe, then we can respond accordingly. The ETF market will respond much more slowly. There are other benefits to the ETF market in terms of cost and so on. But when you have such a theme as AI, which is evolving very, very quickly, it's important, as I believe it is, to retain that position at the pointy end of the spear, if you like, making sure that you're on top of what companies are there doing great things with AI and coming new into your investment universe all the time. We can do that day by day. And I think it's very difficult for the ETFs to do that.
Well, thanks to Chris, and thank you for listening to this episode of On the Money. If you enjoyed it, please follow the show in your podcast app and do tell a friend about it. And if you get a chance, leave us a review or a rating in your podcast app too. You can join the conversation, ask questions, and tell us what you'd like us to talk about via email on otm@ii.co.uk. And in the meantime, you can find more information and practical pointers on how to get the most out of your investments on the Interactive Investor website at ii.co.uk. And I'll see you next week.